The 2024 U.S. presidential election has sent ripples across the global economy. The re-elected president's policies are creating uncertainty. Trade tensions are rising, particularly with China and Europe. Analysts worry about the impact on global growth. These changes are being felt most acutely in emerging markets. These markets are now facing significant challenges. The president's approach to trade is a major concern. Tariffs on Chinese and European goods are being considered. This has sparked fears of a trade war. Such a conflict would have far-reaching consequences. Businesses are anxious about the future. Investors are hesitant to make big moves. The global economy is interconnected. What happens in one part of the world affects everyone. The U.S. election outcome is no exception. The coming months will reveal the full impact of these policy shifts. The world is watching closely. Emerging markets are facing a perfect storm of economic challenges. Growth has slowed, inflation is stubbornly high in many countries. The situation is complex and requires careful navigation. These markets are particularly vulnerable to external shocks. The rising value of the US dollar is a major concern. This makes it more expensive for emerging markets to repay their dollar-denominated debts. It also makes their exports less competitive. This puts pressure on their currencies and can lead to financial instability. Adding to their woes, global trade is slowing. This is partly due to the US-China trade war. It is also a result of the broader global economic slowdown. This is hurting emerging markets that rely heavily on exports for growth. The International Monetary Fund has warned of the risks. It has called on policymakers to act decisively. Failure to do so could have severe consequences. Central banks around the world are grappling with a difficult question: how to manage interest rates in this uncertain environment. The U.S. Federal Reserve's recent rate hikes have created a dilemma for other central banks. On the one hand, raising rates can help to curb inflation. This is a major concern in many countries, but on the other hand, higher rates can also slow economic growth. This is a risk that many central banks are reluctant to take. The situation is further complicated by the different economic conditions in different countries. Some economies are growing more slowly than others. Some have higher inflation rates. This means that there is no one-size-fits-all solution. Central banks are having to make difficult decisions. They are carefully weighing the risks and benefits of different policy options. Their choices will have a significant impact on the global economy. Section 4. Europe's quiet strength. Amidst the global economic turmoil, Europe is a beacon of stability. The continent's economy is proving to be surprisingly resilient. This is due in part to the strength of its banking sector. European banks have weathered the storm well. They have been helped by strong regulation in the wake of the 2008 financial crisis. This has made them better capitalized and less risky. As a result, they are well positioned to withstand the current economic headwinds. However, challenges remain. The Eurozone economy is not growing as fast as it could. Unemployment is still high in some countries, and there are concerns about the level of government debt in some member states. Despite these challenges, Europe is in a relatively strong position. Its economy is diversified and its financial system is sound. This gives it a degree of insulation from the global economic turmoil. Section 5. Currencies in flux. The 2024 U.S. election has injected volatility into currency markets. The U.S. dollar has strengthened against most major currencies. This reflects the uncertainty surrounding the new administration's policies. It also reflects the relative strength of the U.S. economy. The euro has weakened against the dollar. This is partly due to the divergence in monetary policy between the U.S. and the Eurozone. The European Central Bank is expected to keep interest rates lower for longer. This makes the euro less attractive to investors. The Japanese yen has also weakened against the dollar. This is partly due to concerns about the impact of U.S. trade policy on Japan. The yen is often seen as a safe haven currency, but it has come under pressure in recent months. Emerging market currencies have been hit particularly hard. This is due to a combination of factors, including the strong dollar, falling commodity prices, and domestic economic problems. Some currencies have lost a significant amount of value. This is making it harder for these countries to service their debts.